This is Mike Lingle from Rocket Proforma, and today we're going to talk about cash and accrual. And these are two terms you'll hear as you're working on your finances, your financial projections for your business, when you talk to your bookkeeper, when you talk to your accountant. And really, they're just two different tools that you're going to use as you run your business. So the way cash accounting works is the same way you run your wallet. So if you walk down to the coffee store and buy a coffee with cash, you take the cash out of your wallet, you hand it to the coffee store, and they hand you the coffee. The cash is traded hands right then, and you no longer own the cash, but you own the coffee. Accrual accounting works more like a credit card, where there's essentially an IOU. So if you walk into that same coffee store and you pay with a credit card, no cash changes hands. You still have the cash in your wallet, and you'll have the cash in your wallet for the next 20 days, 30 days, let's say. So you get the coffee, but you didn't have to hand over the cash, you handed over an IOU. And that's the way the accrual basis works. From the coffee store's perspective, they do get the use of the cash almost immediately. So they might get that cash paid by the credit card on the same day. And so we'll look at both sides of that equation. But cash is instant transfer of cash. The cash leaves your account. Accrual is an IOU. And this reflects on the three financial statements that you'll deal with in your company. So if you're using QuickBooks or another piece of bookkeeping or accounting software, you'll have an income statement, a cash flow statement, and a balance sheet. And you do need to use all three of these. This was a mistake that I made when I was starting out. I was only looking at the income statement, and so I got in trouble because I ran out of cash. And so the income statement is usually on the accrual basis, the cash flow statement is on the cash basis, and the balance sheet is also on the accrual basis. So there's kind of a mismatch, and that's why you need all three, because cash can look very different from accrual. You can be profitable, we'll see in a second, you can be profitable on the accrual basis, but get yourself in trouble on the cash basis. So let's talk about how this works in the real world. So accounts receivable is if I'm billing a big company, they may take 60, sometimes even 90 days to pay, which is painful. So here's the way that looks. So I invoice the client, and let's say I'm invoicing them $12,000. On the accrual basis, I record that $12,000 as income on my income statement, which is also called the profit and loss or P&L statement. And I record $12,000 to my accounts receivable account, but I don't actually receive the cash. So I've sent the invoice, I've recorded the income, I have this accounts receivable sitting on my balance sheet, but I still don't have any cash. And if the company's going to take 60 days to pay, I may have to wait a few months. So in month 2, I'm waiting. I may even have to borrow money to pay my expenses because I still don't have the cash from the company. In month 3, I finally received the $12,000. So nothing changes on my profit and loss statement because I've already recorded the income in month 1. We subtract the $12,000 from my accounts receivable account on my balance sheet, and I actually receive the $12,000 in cash at that point. So you can see there's a gap between when I invoice the client and when I receive the cash. Even though on my income statement, my profit and loss statement, I'm showing that income, I don't actually have the cash to use. And this is where I can get myself into trouble. On the flip side, accounts payable, this is my business paying other companies. And so this is a little different. I receive a bill from a vendor. I record the expense on my profit and loss or income statement immediately, and I add $12,000 to my accounts payable on my balance sheet. So now I owe money. But I haven't paid any cash. So in this case, it's the inverse. I'm holding on to the cash even though I've received the bill. And if I take a really long time to pay, I'm probably going to upset my vendor. They may have to borrow money in month 2. And then in month 3, let's say I finally pay that $12,000. There's no change to the profit and loss because I've already recorded the expense in month 1. I remove that $12,000 from my accounts payable on the balance sheet, and then I actually pay out the $12,000 in cash. So you can see there's a lag. There's a lag from when I invoice people versus when I receive payment from them, and there's a lag when they invoice me versus when they receive payment from me. A third way that we can look at this cash versus accrual accounting is in deferred revenue. What is deferred revenue? It's a superpower of subscription business models. And so when I go and sign up for a subscription, I often have the option to pay monthly, so it might be $1,000 a month, or I can pay annually upfront. And they usually give me the good rate if I do the annual upfront. So in this case, it's $1,000 a month if I pay upfront for an annual membership. So that would be $12,000 upfront to get that $1,000 a month rate. And so what happens is we prepay that subscription in a lump sum. The company receives the cash up front, but the revenue is recognized monthly on the P&L or the income statement. So the revenue is recognized on the accrual basis. So $1,000 of that lump sum is recognized monthly, but the company has the use of the full amount of the cash. So the company takes the $12,000 up front and then only recognizes $1,000 a month of that on the income statement. So the way that looks is the company receives the $12,000. They only recognize 1/12 of it, 1 month worth of it, which is $1,000 on the P&L or income statement. And they add $11,000 to a deferred revenue account on the balance sheet. But they take that $12,000 in cash up front and they can use that to run the business for the whole year. In month 2, they would record another $1,000 as income on the profit and loss statement. And they would subtract $1,000 from the deferred revenue so that now there's only $10,000 sitting in that deferred revenue account. No cash is changing hands because we took all the cash up front. Month 3, similarly, we record another $1,000 of income on the P&L. We subtract another $1,000 from the deferred revenue account, but still no cash is changing hands, and we do that all the way through all 12 months. So that's how deferred revenue works. And one of the things that subscription companies can do is not just sell 1-year subscriptions, but you could sell 2-year or 3-year subscriptions up front, which can bring a lot more revenue into your business right now, a lot more cash into your business right now that you can use. So when I was launching Rocket Proforma, I signed up for Wix, and Wix gave me the option to prepay not just a year, but 2 years or 3 years. And you can see that they're offering me a bigger discount if I do the 2-year or the 3-year to try to get me to do that because it brings more cash into the company right up front. So consider offering 2-year and 3-year subscriptions. And so what I learned running my business, the first time I was running the business, I was only watching the income statement because I thought that's all I needed. And I wasn't really watching the cash flow. But the cash flow is important. So let's look at an example. If I'm launching a company, it's a B2B company, I have no transactions, but I have expenses. And so you'll see I have no transactions in my launch month. My revenue is 0, but I do have operating expenses because I'm paying for people and servers and whatever else. So my EBITDA on the income statement, earnings before income, taxes, depreciation, and amortization, is negative $50,000. But on the cash flow statement, I may have an additional $15,000 that I put into an office, into a security deposit for my office. So the cash out is actually the $50,000 of operating expenses plus the $15,000 security deposit. So I'm actually in a worse cash position at the end of that period because I'm down $65,000 versus the $50,000 on my income statement. Then if we look at the next 2 months, I start having transactions and my income statement is showing revenue. So now I'm making $127,000 in July, $157,000 in August, and that's covering my operating expenses. So I have money left over. So my EBITDA becomes positive in month 2 and month 3. So this looks great. However, from a cash perspective, I'm billing other businesses and they're taking 30 or 60 or sometimes even 90 days to pay. So from a cash perspective, remember, I'm starting out with that negative $65,000 from month 1, and then I'm paying out another $85,000, but I haven't collected any of the money from the transaction. So on the income statement, I'm seeing revenue of $127,000, but on the cash flow statement, I still have no cash in because these are big companies that are taking me a long time to pay. And I only start to see some of the cash in. So I start to see $25,000 of cash in August, which is a small piece of that of my July revenue. So the July revenue is $127,000, but the cash in, I'm only seeing $25,000 of that a month later. And you'll see from a cash perspective, I'm in big trouble. By the end of August, I'm down over $200,000 in cash, even though on my income statement, I'm showing a profit. So just keep track of your income statement and your cash flow statement. Again, this is a mistake I made when starting my own business. And I got it right the second time around, but not after some painful experiences. And just remember, cash and accrual, they're simply two different tools. You can think of cash as a hammer and accrual as a screwdriver. You need both in order to do a construction project. You can't just use the hammer or just use the screwdriver. So it's not that you're picking one or the other, it's that you're using both as you run your business and think about your finances. And one of the best cash managers was Bill Gates. When he was running Microsoft, he had a rule that Microsoft always had to keep a year of cash available. And his thinking was if there was something horrible, like let's say a global pandemic and all business stopped, he would have a year of cash plus a bunch of smart people, and they would be able to figure it out. And fast forward to Bill Gates is one of the richest people on the planet and is actually, pre-funding 7 factories for COVID vaccines, most of which he expects to not actually produce anything. But this is a guy who always managed his cash and his investments very well. So I've done the same thing and always try to keep a chunk of cash available for my business for when unexpected things occur. So that's a quick primer on cash and accrual accounting. Again, visit Rocket Proforma, rocketproforma.com. This is Mike Lingle. Thanks so much.